How's it going, guys? Welcome back to mentfx. And something that I wanted to talk about today was how to decipher what range you're in, what the most probable next move is, and how to expect that move within the range that you're working with. So you, as a lot of you know, actually by this point, understand that we do top-down analysis here at mentfx. If you don't know what I'm talking about, go look up some of my other videos. But the general idea is we come and look at where we are in a given market, try to understand how the market is moving in certain areas, and begin to formulate ideas about how that market is going to move into the future based on inefficiencies created in the market on the way down, right? Whether it's in a mark down such as this with imbalance left behind, and how it had liquidated previous people out of positions to come and take them out, and then shift structure in a way that allows for them to come and create a more bullish bias. Now, because we're not banks and we can't just look at a market like this on a monthly time frame and do something as simple as drop onto a monthly, place a little buy here, stop just below the lows, targeting some of the liquidity highs and inefficiencies available in some of these areas, right? Whether it's those or these ones right here, right? Just target some of those highs, maybe give us something like this at about a 1 to 0.5, put a few $1 billion on this stop loss, and just allow this to play out over the next, 5-6 years. And if it delivers, we easily secure an extra, 800, 900 million for our fund. Now, because we're not large banks or institutions and can't just constantly get into plays like this or allow it to pull back and get into some better plays here and make billions of dollars on these moves, what we do is we study the price from a top-down perspective to understand what the most probable next area of interest or next target is going to be, and how do we do that? So looking at this market, I'm not going to get into a super deep top down, but ultimately from when this low is created, and a lot of people in the mentorship know what's going on here, and we'll talk about this on the weekend, but if you want to go and experience that and learn about that, make sure you check out my website at launchpass.com/mentfx. The link is in the description, but other than that, you don't have to join. Use the free stuff and learn from this. So ultimately, ever since this grab of liquidity below these lows, which we understand are lows because there are stop losses under them, aka sell stops, those sell stops are breached, taken up by the institutions or by the composite man or by smart money, and taken to the top side. And as this top side is delivered, we begin to put in motion a bullish structure, which is now pretty much being held, and more likely than not, we are going to see a pullback into or around the demand zones in these areas here, which are the last down moves before the up moves, with little bits of inefficiency in the form of imbalances right here, just inside of the zone. So if you wanted to, you could refine the zone to something like this, but ultimately the next most probable move in this market would actually be to come and meet this zone before coming to meet higher prices above, more likely than not, the equal highs forming right now. So this is going to be that cookie for a lot of smart money, for a lot of dumb money, and for those dumb institutions or dumb money institutions, because remember, dumb money does not just apply to retail traders or people with a little bit of money. It also applies to hedge funds. It applies to governments, it applies to countries. If you've done any research on it, you understand that even back in historical times, America would sell off certain contracts to China and then completely liquidate the Chinese contracts, because this idea of manipulation has always been around and isn't here just to kind of take out the little retail traders that are sitting there with their nice little demand and supply zones, not demand supply, sorry, their support resistant zones, but is actually a tactic utilized across all disciplines and used to liquidate some of the best hedge funds and biggest banks in the world. So with this expectation, although we expect the sell into the buy, we're not, again, institutions, so we can't just look to sell candles and buy them. But what we do understand is that below and above every swing, as we saw here, are oftentimes sell stops or buy stops. And those are going to be catalysts, or they're going to be future areas and targets that price will come to meet to allow themselves to grab more orders to continue higher. Similarly, if we follow these liquidity lows, you can see liquidity is created over this month, right? So this was the month of April. The next month in May comes to take out that liquidity. By taking out that low right here, all the composite man people or smart money or smart institutions come to liquidate those people, take out their orders. And again, this is monthly level data. So these are commercial banks or dumber banks getting liquidated, getting taken out and taking it to the top side. As we have a top side price delivery, we begin to leave behind new areas of imbalance. Those imbalances are fulfilled, and as those imbalances are fulfilled with this down candle, for instance, we also liquidate the people and banks and hedge funds and governments and companies, etc., that are placing their stops or placing their hedges under the lows here, and those are tapped, inefficiencies are fulfilled, and price again expands to the top side. And as it does this, the same thing repeats. We begin to create certain lows, and these lows function as future areas in which new stops will be activated, taken out, hedge positions will be taken, and the price will continue to deliver in a given direction. So don't take my words for this. This is not financial advice by any means, but this is what we do to view the market and what a lot of my students do to be consistently profitable and full-time in the market. So based on the fact that we understand that this price has expanded to the top side and more likely than not will continue to expand over the long term to the top side, that expansion is more likely than not going to be seen with a mitigation or a move back, a sell into a buy into or around the areas in this specific zone, which we can maybe kind of refine on a 2-month. There you go. So you have this last down move before the up move. So more likely than not, we are going to come to grab this and continue higher, which we can already see just by zooming in can give us a target, if we are to set a target, of certain lows that have already been created, like this low right here. So already, just based on where we are in price, this right here is a perfectly fine target for you to have. So this could be an inner term lower liquidity. That's what this stands for. And ultimately, you can now delete this zone. You can delete your zones up here. Nothing really matters. What really matters is that we are instantly expecting this right here to be a protected high of sorts for now that is going to ultimately hold this price down, or institutions that had bought into this to liquidate the people above this liquidity high have been basically taken out by this move up. This collapsed back down, and now, more likely than not, even if we are to sustain this up move, even if we're not, the most probable next area for smart money to accumulate, distribute, or hedge, or pick up more orders is going to be at this liquidity low right here, which we can jump down now back again to the monthly time frame. You'll actually notice are perfectly equal lows. So again, even though it might not seem like that, we can interpret and see price across all time frames just by looking at one, right? If we go to a daily or a 4-hour chart now, we're probably going to see these equal highs in a much better light. So if we go to a daily, right here, we have again what a lot of people would call a beautiful little support that I'm going to buy at. No. There's probably going to be some kind of mitigation here and continuation upwards. All this price action in here is ultimately the trap set by smart money, right? All this, right? Even here, this third move up, even though we were able to capitalize on this in the group and make money off this move up, we understand that a lot of support and resistance traders that are looking to take these buys or these engulfing candles where they're only getting involved at the tops here are getting liquidated very quickly after getting involved, rather than being with mentfx and looking to get involved on the demand zones prior inside of these areas and looking to take those on the lowest time frames to the top with the expectation that we're still going to decline lower. So what's interesting now is that just by looking at the monthly time frame, we've been able to ascertain and decide where the most likely next movement of price will be, whether it goes and moves there right now this month, or whether it takes off for a little bit and then comes and moves to this low. But what's important is that we understand what a target and a good target will resemble into the future. And the reason it's so important to have areas like this is because what you're doing when you draw out a target like this is you're actually setting an expectation for areas where you know, based on smart money concepts and the way that we've taught on this channel, there are already stop losses or sell stops laying below and above these areas. So ultimately, price has to target this high or this low, right? We ascertain or we predict that these lows are going to be targeted because of the way that we've taken out targeted highs and now the way that we're moving down. And as a result of expecting price to even tap into deeper bearish areas, we know that those deeper bearish areas will be met with the movement that comes to tap and take out the sell stops below these lows right here. So we expect price to drop down there and then either reaccumulate to keep going higher or begin to redistribute to come lower before those moves higher begin. But either way, the most important thing that you take from this is that the target remains the same at these equal lows, or very simply that 2-month wick created right there, which acts as inner term liquidity. And again, you can draw out this wick as well, which you also understand on a time frame is also, so let's delete these brush tools, which you'll understand also on a lower time frame is also an area of liquidity. So in the future, this will become some kind of target, but right now it is no it is basically not needed to be used. Now, what's interesting about doing what we did here is we are setting a premise for what price wants to do. So basically, based on where price is right now, this is a down candle starting a down month ultimately, right? We can see that month started going up, down, whatever it is that it did. We can draw basically this area right here. And although this looks very small, understanding that this tiny bias, this tiny motion of understanding that price wants to kind of move down here gives you this entire area on a lower time frame in which you can look for sells down. And it may seem small here, but if we actually measure the size of this is about 161 pips to look to the downside, which for people that only think about price in terms of pips is actually a very good amount of pips to look to aim for. Now, again, it doesn't mean that you should just sell this and take it lower, because there's also chances that price may, on a shorter time frame, want to come and target this high, right? Take the buy stops above that high and then target the sell stops down here. That is also something that's possible. This is how we create stories. We're going to get much more in depth with this in the mentorship. However, right now, the most important thing is to recognize that when you create a target like such, you also create for yourself a range based on where price is right now. Now, if price increases and the next month goes like this, for instance, your range increases to this entire move here. So now you have an entirety of 390 pips, so about 400 pips to look for price to aim to the downside, which means any lower time frame shifts inside of this area right here. So if price were to make some kind of large move up and then start making a move down, any shift in these supply zones act as a beautiful zone for you to look for confirmation in the form of either mentfx blocks, which are exclusive to the mentorship, or Wyckoff, to take yourself short, or just structural shifts, right? Just normal structural shifts, to take yourself short into the desired areas of liquidity resting below, which we already have found using a higher time frame, not needing to go to like a 15, 30 minute, 1 hour to view it. Because remember, as I always say, timeframes don't exist for the purpose of actually looking at different times, because like, as a lot of you know, there's a lot of smart money that will teach you like this and say, you know, you have your range, now look for the range to break, now you have a new range, now look for the range, now look for the range. That's not why price exists the way it does. Price does not exist on a time frames because of time frames. Price exists on different time frames, and we use different time frames to see how orders had been made in that market and where orders are more likely to target based on a probable approach of where price wants to go. Just like right now, and we've spoken about this for a while, price will more likely than not want to target these lows before targeting anything else on a higher time frame, such as this high. Why? Even when price was here, why is it more likely to target here than here? Well, because if we do want to continue that upwards movement, we know we need to do that using the liquidity present in the market, and to pick up some of that liquidity to create that fuel to keep moving in a given direction, we need to go and tap into sell stops to allow them to function as areas where we can buy in, and either buy in and continue going higher, or continue trading down into those higher time frame areas, such as the demand zones present in these zones here and these zones here, before we see those markups off of Wyckoff accumulations to continue that bullish push. And as that happens, we now see these protected highs, or areas that we previously believed to be protected highs, become the areas that we want to target as places where there's buy stops, which will function as profit taking for smart money. So why is it so important that we're drawing out this expectation and drawing out these lower ranges? Because now we understand that on a certain time frame, or even right now, we are bound by price to basically have free entries anywhere inside here to go short down into the targets here. Which means if you're looking at, for instance, the structure being delivered to you here, such as the so we can actually mark this, we'll just do it really quickly, but lower high, right? A lower high here, lower low right here, a new lower low right here, right? And now potentially a new lower high, which might be made a little bit higher. We understand that if this bearish structure is to continue and sustain, and we are able to find lower time frame entries off of the supply zones and find some kind of Wyckoff distribution, which there already might be, but we're not going to look into that right now. If there's a Wyckoff distribution we can take down, or a break of structure, or a head and shoulders, whatever it is that you guys like to trade, that we can take down into those targeted areas, well, then we understand that that is profit to be made. Now, on the other hand, if price does begin to break higher and put in bullish structure, we know that that bullish structure isn't existing there to take us to new highs and go to the fucking moon, because we know that we're looking for price to still, even if it makes its way up into these zones here, to still target the lows right here. Why? Because those are the next lows that make sense to be targeted if we are to deliver prices on a bullish basis and go and pick up orders to keep going higher, which means as long as price stays within these two zones, this range bound zone now, we have opportunities to look for longs or shorts into them. So the most important thing that I need you to take out of this ultimately is that when you set targets for yourself in price and where price wants to go, and you set invalidation points, right? So we have an invalidation point here and a target here. You give yourself the ability to wait for price to either give you the perfect setup to go short, to give you the perfect setup to go short, or you wait for that invalidation to be able to create a new bias and begin to trade that story, which again, you will know a lot about if you've been watching my content a lot, where we constantly talk about the creation of a story in the delivery of price and understanding how we basically use that to know where price wants to head. Now, that would be a much higher time frame approach, right? We do this every day on the lower time frames. People have been killing it in the mentorship on the the second time frames, the minute time frames, the 5-minute time frames, the 15-minute, whatever it is that suits their personality. So what we're doing is, again, applicable across all markets, all timeframes. And if you don't know about any of this and want to see a little bit more about it, go follow my Instagram. That stuff is free too. Now, the cool thing about understanding that we're also targeting these lows down here, which are those monthly lows, and we go and take a look at the daily, for instance. Let me see. Maybe I think there was a weekly we were looking at. Yep, perfect. So if we understand that we're targeting these lows, as we get to a lower time frame, and again, this is the last example I'll do, but you can do this across all time frames, you need to understand that the weekly will also create certain ranges that you're trading in, which could just be the previous week's highs and lows that function as, again, areas of liquidity. Now, what's interesting is if you understand, and if your bias or if your belief is to see that price wants to come and take out these lows right here in the form of sell stops, then you understand that sometimes price will make a pullback and go grab buy stops to meet the sell stops, which means either we can already start to look for the sells on those lower time frames down into those zones and come and take out those sell stops and be part of the smart money move that comes to liquidate people, governments, businesses, or whoever else is in this market that isn't us retail traders, which only, again, make up about 5% of the market. So always remember that you're literally about 5% of the overall market. That's happening basically when you see price movement. So you don't matter. So stop thinking you do, and stop thinking smart money is going to change, because it can't if you really understand how it works. Now, what's interesting about this is either this can be true, or you can set a premise for yourself where you want to see, for instance, price reach up into the buy stops above these highs, which again, on a lower time frame, are going to be areas that you can then see very clearly as areas that look like highs that want to hold, that are actually just going to be liquidated, right? But we're not looking at that right now. That are going to be taken out. Those buy stops get taken. As those buy stops are taken, new sells are being met, counterparty by who? Smart money or institutions, and those sells can then take the market lower to the sell stops, where they can take profit as well as begin to get into new buys to start a new markup or markdown, right? This is just the Wyckoff cycle. Wyckoff cycle is a markup. The markup is finished. We mark down, right? And we kind of repeat this, and within that, we create liquidity and we mark up, take out liquidity, we mark down, take out liquidity, right? And so on and so forth. The market, any market, travels in cycles of mark up and mark down. And the reason it does that is because it's securing itself liquidity on each end. The market moves from liquidity to liquidity, and that's it. So under this premise, you could also believe, right? And if you take this a little bit further than just highs and lows, you can then take it to the state of, okay, we have an imbalance here. Maybe we want to see the imbalance filled. So what would that mean? That would mean that our actual target would not only be this high right here on a short term, but also this potential high right here. Because on a lower time frame, again, what is above this high? Buy stops of people that are setting their stop losses right above this, trying to ride this bearish move down, which means that still, even when we get here and we take those people out, we're not necessarily liquidating them and making them lose money. What's actually happening is those people could have gone in the sells up here and then moved their stop to this high, then to this high, and now to this high, and then maybe even to this high, which means when price takes them out, they're actually making money on this move down, but the money that they're not making is being taken over by the institutions that understand what the larger time frame targets are and then are met on the lower time frames. So under this premise, you can again have a new range. So if you're bullish on this market, or you see a lower time frame bullish market unfolding inside of that, you know that that bullish market can target as high as this target right here, the upper inner term higher liquidity. And as it comes to target that liquidity, then the meeting of that liquidity can be met with the down moves that come to meet the lower liquidity here, which we can again see just by playing around with the time frames we're looking at and understanding how the highs and lows in that time frame function, because those highs and lows create buy stops and sell stops. Now again, you don't do this on its own. This is a way to understand range-based trading, which means if this was true, all this right here is valid for a buy, right? So all this area in here, which is about, what is this? About 139 pips, is valid for you to look for buys. Now, that doesn't mean that you just take a buy, get your 139 pips by risking whatever lows you want to risk and say, yeah, I made my pips. It doesn't really matter. It doesn't mean anything. But if you approach it from a standpoint of using section 1 through section 3 of the private mentorship, right? Structure, S&D, Wyckoff, and you look for confirmations to take it higher, or if you're a retail trader and you want to look at this and look at some moving average crossovers to go long, then you know your long targets are going to be preset by these previously potentially protected highs and lows, and where you expect residing sell stops or buy stops to be. And that's how you look for price to meet to certain areas. And the reason that you can be more confident in your approach by having targets set like this is because the market targets and only moves from liquidity to liquidity. Now, it gets deeper than that, and we do go into that in the mentorship and talk about how structure develops into the market and how you can then utilize that with the idea of range-based and liquidity and structure and S&D and Wyckoff. But right now, this is the most important thing that I think I needed to get across to some of you people, to maybe go and up your trading. Now, again, you don't need to be a smart money trader to be able to do this. This can actually create great targets for you as even a retail trader if you don't have good targets to basically take using your current strategy. So understand that when you create and mark out a certain high and a certain low, you create a range for yourself in which you can then look for confirmations or structural shifts to then take those buys at certain demand zones off of Wyckoff or whatever it might be to the highs presented by the liquidity you mark out. And you understand that that can be met as an actual target because those areas are the exact areas in which institutions, governments, commercial banks, other banks, dumb money, smart dumb money, across the board are mitigating their positions. Now, what's interesting is if I was in a sell from up here on GU, which I'm not talking about right now, but if I was in a sell, then it would also make sense for me to begin to mitigate my position down to these zones, because I understand if this is met, there's a good chance that I can get a new sell in up here, which is fine, but that's dumb smart money, or that's smart money that likes to trail aggressively, or just normal people that want to trail aggressively, or commercial banks that trail aggressively, getting stopped out, having their take profits met technically in profit, but being stopped out and having their buy stops met as price comes and takes them out before continuing a certain move. And that is how you use highs and lows to determine exactly where you want to target, and how you use those targets as potential ranges that you bind yourself into, and you allow for points to act as invalidation points and take profit points. And as long as you stay under your invalidation points, you have great entry criteria to take down into those points, and you create potentially either more pips, which we don't use, but better yet, more RR. So hopefully this video made some sense. Thank you all for the immense support. The uploading is going to be a little bit less consistent now. We are in the process of buying a house and moving currently, and I'm working a lot with one-on-one students in the mentorship. But if you do want a chance to join an amazing lively community and be able to talk to me and to other amazing profitable traders, check out the website in the description and feel free to join. Thank you so much, guys. I hope this helped out some of you. Let me know in the comments below if it did, and I'll see you guys in the next video.